What if I told you that one of the biggest reasons traders lose money has nothing to do with strategy? It has nothing to do with indicators, and it has nothing to do with market manipulation. It's something much simpler. Overtrading. The habit that quietly destroys more trading accounts than most people realize. Because many traders believe that the more they trade, the more money they can make. So they keep searching for opportunities. Every candle looks like a setup. Every movement looks like a chance to profit. And before they know it, they're taking trade after trade after trade. Not because the opportunities are good, but because they feel the need to be involved. They feel uncomfortable doing nothing. They think waiting is wasting time. But professional traders understand something completely different. The market doesn't pay you for activity, it pays you for accuracy. A hedge fund trader isn't sitting in front of a screen desperately trying to force trades all day. They're waiting, observing, analyzing, and sometimes doing absolutely nothing. Because they know that patience is a position too. But losing traders often confuse movement with progress. They think being busy means being productive, so they keep clicking. And every unnecessary trade creates unnecessary risk. The more you trade without a valid reason, the more opportunities you create to lose money. That's why overtrading is so dangerous. It doesn't just drain your account, it drains your discipline. It trains your brain to chase action instead of quality. And once that habit develops, trading becomes entertainment instead of a profession. That's when mistakes multiply. That's when emotions take control. And that's when consistency becomes impossible. Because profitable traders don't make money from taking more trades, they make money from taking better trades. The second thing losing traders must stop doing is revenge trading. This habit has destroyed more accounts than bad strategies ever will. Because revenge trading doesn't come from logic, it comes from emotion. And the moment emotions take control, discipline disappears. Every trader knows what it feels like. You enter a trade, you believe it's going to work, you imagine the profit before it even happens. But then the market moves against you, your stop loss gets hit, and suddenly something changes. You're no longer calm, you're no longer objective, you're frustrated. You feel cheated. You feel like the market took something from you, and deep down, you want it back immediately. That's when revenge trading begins. Instead of stepping away, instead of reviewing the trade, instead of accepting the loss, you jump right back into the market, not because there's a setup, not because your system says so, but because you're angry, because you want your money back, because you want to prove that you're right. And that's exactly why revenge trading is so dangerous. The market doesn't care how you feel. It doesn't know you're frustrated. It doesn't know you're trying to recover losses. And it certainly doesn't owe you anything. But many losing traders act as if the next trade must pay them back. So they force entries, they ignore risk, they increase position sizes, they abandon the plan completely. And what started as a small, controlled loss turns into a disaster. Professional traders understand something that losing traders often don't. Losses are part of the business. Even hedge fund managers take losses. Even institutional traders take losses. Even the best traders in the world are wrong regularly. The difference is how they respond. Professionals don't try to get their money back immediately. They focus on protecting their capital. They focus on protecting their mindset, because they know a clear mind is more valuable than forcing another trade. A hedge fund trader can finish the day red and remain completely calm. Why? Because they understand probabilities. They know that one trade means nothing, one loss means nothing, one bad day means nothing. What matters is the process. What matters is consistency. What matters is following the system. But revenge traders don't think that way. They become obsessed with recovering losses, and the more obsessed they become, the worse their decisions get, because now they're no longer trading their strategy, they're trading their emotions, and emotions are terrible traders. Fear enters, frustration enters, desperation enters. And once desperation enters your trading, the market becomes a very expensive place. That's why some traders can destroy weeks of progress in a single afternoon, not because their strategy stopped working, but because revenge trading took over. One loss became two, two losses became four, and before they knew it, their account was bleeding. All because they couldn't accept being wrong. And that's one of the hardest lessons in trading. You must learn to be wrong. You must learn to lose. You must accept that losses are part of the game. Because the traders who survive are not the traders who never lose. They're the traders who lose correctly. They respect risk. They stay disciplined. They stay patient. And most importantly, they never allow one losing trade to turn into an emotional spiral. Because the moment you start trading for revenge, you're no longer trying to make money. You're trying to satisfy your emotions. And that is one of the fastest ways to stay a losing trader. The third thing losing traders must stop doing is risking too much money on a single trade. This mistake has ended more trading careers than most people realize. Because many traders aren't losing because their strategy is bad. They're losing because their risk is completely out of control. Think about it. You spend hours looking for a setup. You analyze the charts. You convince yourself it's the perfect trade. And then you make a dangerous decision. You risk far more money than you should because you're confident, because you want bigger profits, because you're tired of slow progress. And that's exactly where the problem begins. The market doesn't care how confident you are. The market doesn't care how good the setup looks. The market doesn't care how badly you want the trade to win. A good setup can still lose. A perfect setup can still fail. And when that happens, oversized risk becomes extremely expensive. This is why professional traders think differently. A hedge fund manager never assumes a trade will win. They assume it could lose. That's why risk management comes first, before the entry, before the profit target, before everything. Because professionals know something most losing traders ignore. Survival comes before profits. You cannot become consistently profitable if you keep blowing up your account. Yet many traders are trying to change their lives with one trade, one position, one setup, one lucky move. They're looking for a shortcut, but shortcuts usually lead to destruction. Because when you risk too much, your emotions become impossible to control. Every candle suddenly feels important. Every pullback feels terrifying. Every small movement feels like a threat. You start watching profits and losses every second. You become emotional. You become fearful. You become impulsive. And once emotions take over, your decision-making gets worse. That's why oversized risk creates more than financial damage.
it creates psychological damage. You stop thinking clearly. You start hoping instead of analyzing. You start praying instead of following a plan. And that's not trading. That's gambling. Institutional traders understand that their first responsibility is protecting capital, not making money. Protecting money. Because if you protect capital long enough, opportunities will always come. But if you destroy your capital, the opportunities no longer matter. Many losing traders think risk management is boring. They think it's slowing them down. They think small risk means small success. But the opposite is usually true. The traders who survive the longest are often the traders who risk the least, because they understand that trading is a marathon, not a sprint. A professional trader doesn't need one trade to change their life. They need thousands of disciplined decisions made correctly over time. That's how consistency is built. That's how confidence is built. And that's how accounts grow, slowly, steadily, without emotional chaos. So if you're still risking too much on one trade, ask yourself this question. Are you trying to build a trading career, or are you trying to get lucky? Because the answer to that question will determine your future as a trader.
The fourth thing losing traders must stop doing is chasing every new strategy they find. This is one of the biggest reasons traders stay stuck for years. Not because they aren't learning, but because they're learning too many things at the same time. One week they're trading moving averages. The next week they're trading price action. Then they discover smart money concepts. Then ICT. Then supply and demand. Then another indicator. Then another course. Then another mentor. And the cycle never ends. They're constantly searching for something better, something easier, something that never loses, the perfect strategy, the Holy Grail. But here's the problem. The Holy Grail doesn't exist. Every strategy has losing trades. Every strategy has drawdowns. Every strategy has periods where it performs poorly. Even institutional traders experience losing periods. Even hedge fund managers experience losing months. The difference is that professionals understand this reality. They don't abandon their system every time things get difficult. They trust the process. They trust the data. They trust the edge they have developed over time. But losing traders often do the opposite. The moment they take a few losses, they start doubting everything. They start searching YouTube. They start buying new courses. They start looking for another indicator, another setup, another shortcut. And before they know it, they've spent months learning without actually improving. Because mastery requires repetition. You cannot master something you're constantly changing. Think about a professional athlete. Imagine changing your technique every week. Changing your coach every week, changing your training plan every week. You would never improve. The same thing happens in trading. Consistency comes from repetition. Repetition creates experience. Experience creates confidence, and confidence creates discipline. But if you're always changing strategies, you never stay with one long enough to understand it. You never learn how it behaves during losing periods. You never learn its strengths. You never learn its weaknesses. And because of that, you never develop trust in your system. That's why many traders become strategy collectors instead of profitable traders. They have 10 different systems, 20 different indicators, hundreds of screenshots, thousands of hours of content consumed. Yet they're still losing money, not because they lack information, but because they lack commitment. Professional traders understand that one good strategy executed consistently is usually enough. Not 10 strategies, not 20 strategies. One.
applied with discipline, applied with patience, applied long enough for the probabilities to play out. That's how hedge funds operate. They don't wake up every morning looking for a completely new method. They build a process, they test it, they refine it, and then they execute it repeatedly, year after year. Because success in trading is rarely about finding something new, it's usually about mastering something you already have. And that's a lesson many losing traders learn far too late. The trader who keeps chasing new strategies often stays in the same place, but the trader who commits to one proven process and masters it is the trader who eventually becomes consistently profitable.
The fifth thing losing traders must stop doing is ignoring their emotions. This is one of the most underestimated mistakes in trading, because most traders believe trading is only about charts, only about entries, only about indicators, only about strategy. But the truth is, your emotions are involved in every single trade you take. Fear, greed, hope, frustration, impatience, confidence, doubt. Whether you realize it or not, these emotions are constantly influencing your decisions. And if you don't learn how to control them, they will control you. That's why two traders can use the exact same strategy, take the exact same setups, and still get completely different results. One follows the rules, the other follows emotions. One remains disciplined, the other becomes impulsive. One trusts the process, the other panics the moment things become uncomfortable. And over time, the disciplined trader survives, while the emotional trader struggles. Because emotions have a way of making smart people do stupid things. Fear makes you close winners too early. Greed makes you hold positions too long. Hope makes you stay in losing trades. Frustration makes you revenge trade. Impatience makes you enter before confirmation. And before you know it, your emotions have completely taken over your trading. That's why many losing traders don't actually have a strategy problem. They have an emotional problem. The strategy works, the rules work, but they can't follow them consistently. Because every time emotions appear, the plan disappears. Professional traders understand this. That's why they spend years developing emotional control. A hedge fund manager isn't paid millions because they can predict every market move. They're paid because they can remain disciplined under pressure, because they can make rational decisions when others are emotional, because they can stick to the process when everyone else is panicking. And that's a skill most retail traders never develop. Many traders spend years studying charts, years studying indicators, years studying price action, but they never study themselves. They never analyze their behavior. They never identify emotional patterns. They never ask themselves why they keep making the same mistakes. And because of that, the same problems keep repeating. The same losses keep repeating. The same frustration keeps repeating. That's why many professional traders keep journals, not just to record trades, but to record emotions, because they understand something important. The biggest enemy in trading isn't always the market. Sometimes it's the person sitting in front of the screen. Sometimes it's the fear that makes you hesitate. Sometimes it's the greed that makes you break rules. Sometimes it's the ego that refuses to accept a loss. And until you learn to control those emotions, consistency will always remain difficult. Because profitable trading isn't just about having an edge, it's about being able to execute that edge consistently, day after day, week after week, month after month, without letting emotions interfere. And that's exactly what separates professionals from losing traders. Professionals don't eliminate emotions, they learn how to manage them. And that ability becomes one of their greatest advantages in the market.
The sixth thing losing traders must stop doing is trying to get rich quickly. This dream has destroyed more traders than bad strategies ever could, because the moment you enter the market believing you're going to get rich fast, your decision-making changes, your expectations become unrealistic, your patience disappears, and your risk increases dramatically. You start looking at trading the wrong way. Instead of seeing it as a skill, you start seeing it as a shortcut. Instead of focusing on consistency, you become obsessed with quick profits, and that's where the problems begin. Because the market has a way of punishing desperation. The more desperate you are to make money, the more emotional your decisions become. You start forcing trades, you start increasing position sizes, you start taking setups you would normally avoid, and all because you're trying to speed up the process. But professional traders understand something most losing traders never learn. Trading is not a get-rich-quick business, it's a get-rich-slowly business. A hedge fund manager isn't trying to double an account in 1 week. They're trying to generate consistent returns over years, because they understand that long-term success comes from discipline, not excitement. Yet many retail traders enter the market expecting miracles. They want to turn a small account into a fortune in a few months. They want financial freedom immediately. They want life-changing money right now. And because of those expectations, they take life-changing risks. Unfortunately, those risks usually change their lives in the wrong direction. Because the faster you try to get rich, the more likely you are to blow up your account. That's why many traders spend years repeating the same cycle. They deposit money, they get excited, they take oversized risks, they make a little profit, they become overconfident, they increase risk even more. Then one bad trade arrives, and suddenly everything disappears. The account is gone, months of progress are gone, confidence is gone, and the cycle starts again. Professional traders avoid this trap completely. They understand that consistency matters more than speed. They know that protecting capital matters more than chasing profits. They know that surviving the next 1,000 trades is more important than making money on the next one. And that's why they think differently. While losing traders ask, "How much money can I make this month?" professionals ask, "How can I improve my process this month?" While losing traders focus on outcomes, professionals focus on execution. While losing traders dream about fast success, professionals build systems that create long-term success. Because they understand a simple truth. Wealth built slowly is usually wealth that lasts, but wealth chased quickly often disappears just as quickly. That's why some of the best traders in the world became successful through years of discipline, not weeks, not months, years. They respected the learning process, they respected risk, they respected patience, and most importantly, they stopped trying to get rich quickly. Because the moment you stop chasing fast money, you start making better decisions. You become calmer, more patient, more disciplined. And ironically, that's when profitability finally starts to appear. And finally, the seventh thing losing traders must stop doing is not treating trading like a business. This is where many traders fail before they even realize it. Because they approach trading the same way people approach gambling. They open charts randomly, take random trades,
risk random amounts, and hope for random profits. There is no structure, no routine, no process, no accountability, just emotions and hope. But hope has never built a successful trader. Think about any successful business in the world. A business has rules. A business tracks performance. A business manages risk. A business has a plan. A business knows its numbers. And most importantly, a business focuses on long-term survival. Yet many traders do none of these things. They spend hours looking for entries, but almost no time reviewing mistakes. They obsess over profits, but rarely analyze losses. They know every indicator, but they don't know their own statistics. They don't know their win rate. They don't know their average risk-to-reward ratio. They don't know which mistakes cost them the most money. And because they don't track anything, they can't improve anything. Professional traders understand this. Many institutional traders document everything. Every trade, every mistake, every decision, because they know improvement comes from measurement. A hedge fund manager doesn't wake up and trade based on feelings. They follow a process, a framework, a system that has been tested and refined over time. Because consistency doesn't come from motivation, it comes from structure. That's why many losing traders remain stuck for years, not because they're incapable, not because they're intelligent, but because they operate without a business mindset. They treat trading like entertainment, like a hobby, like a game. But the market doesn't reward hobbies. The market rewards professionalism. The market rewards discipline. The market rewards preparation. That's why the traders who succeed are often the ones doing boring things consistently. Keeping journals, reviewing trades, managing risk, following plans, measuring performance, again and again, day after day, month after month, year after year. Because they understand something most losing traders ignore. Success in trading is not built from one great trade, it's built from thousands of disciplined decisions. And the moment you start treating trading like a real business, your perspective changes. You stop asking, how much money can I make today? And you start asking, how can I improve my process today? That single shift changes everything, because businesses that focus on process usually become profitable, and traders who focus on process usually become consistent. That's why the final step to escaping the losing trader category is simple. Stop treating trading like a lottery ticket. Stop treating it like entertainment. Stop treating it like a shortcut to wealth. Treat it like a business, because the traders who do that are usually the traders who survive long enough to become successful.
And in the end, all 7 of these mistakes have one thing in common: overtrading, revenge trading, risking too much money, chasing every new strategy, ignoring emotions, trying to get rich quickly, and not treating trading like a business. They all come from the same place: a lack of discipline. Because the truth is, most losing traders already know what they should do. They know they should be patient. They know they should manage risk. They know they should follow rules. The problem isn't knowledge. The problem is execution. And that's why some traders spend years in the market without making progress. They're searching for a new strategy when what they really need is a new mindset. They're looking for a better indicator when what they really need is better discipline. They're trying to master the market without first mastering themselves. But professional traders understand something different. The goal isn't to win every trade. The goal is to make good decisions consistently. Because if you make good decisions consistently, the profits eventually take care of themselves. That's why hedge fund managers focus so heavily on process, not because process is exciting, but because process produces results. And that's the lesson. If you want to stop being a losing trader, stop focusing on making money and start focusing on becoming the kind of person who deserves to make money. Become more disciplined, more patient, more emotionally controlled, more professional. Because profitable traders are not created by one winning trade. They're created by thousands of disciplined decisions repeated over time. And the day you stop chasing shortcuts, the day you stop looking for miracles, the day you commit to the process is the day you finally give yourself a real chance to become consistently profitable. Because in trading, success doesn't belong to the smartest trader. It doesn't belong to the luckiest trader. It belongs to the trader who can stay disciplined long enough for the probabilities to work in their favor. And that trader can be you.